Good morning. Even with all the recent challenges and regulator restrictions, the Australian property investor remains a popular player in our property market. However, building wealth through property investment can be a lot of work, particularly if you're new to it and are not aware of exactly what's required and of all the variables involved. So this morning I'm here with Anthony Landahl from Equilibria Finance. Good morning, Anthony.
G'day, Connor.
And Anthony is going to take us all through a look at how to avoid some of the common mistakes made by first-time property investors.
Yeah, thanks, Connor. It's a really important topic for first-time investors to get right. So let's take a look at some of the main issues and considerations for them. Firstly, do your homework. Many people make the mistake of buying a property simply because they think it's a bargain or they like it. However, not every property makes a good investment. So when you find a property that you might like to purchase, it's very important that you do your research to ensure it will give you the return on your investment that you will need.
Thanks, Anthony. So what are some of the key considerations?
Yeah, in terms of the research, some of the key considerations to ask will include, will it be easy to find tenants? Will the property be in high demand? What rental income can I expect? And does the property have strong capital growth potential? Is it in a growth suburb? Am I paying the right price? And how long do I have to actually hold the property before I can make a profit by selling it? The second area I want to look into is that a lot of first-time investors don't factor in all the costs. For a property investor, cash flow is a very important factor, and it's the area where many first-time investors come undone. It's not only important to factor all the costs of buying the property, you must also factor in the costs of running it as an investment and maintaining it from the outset. So when you do your research of the rental income you can expect from the property, you first need to know exactly how much rental income you'll need to cover the costs of holding the property, and also the actual costs will vary from property to property. Ask yourself these questions. Will the rental income be enough to cover the costs of a property manager, advertising for tenants, regular general maintenance, council rates, building insurance, landlord insurance? How will I cover the costs of large repairs, for example if the hot water system needs replacing quickly? And what's the contingency to cover the costs when the property is untenanted and there is no rental income? Another question is, how long is the average vacancy time in this area? And what time frame will I have to budget for vacancies?
Okay, great. And so Anthony, what else should they consider?
Property management's key. A property manager is the liaison between you as the landlord and your tenant. A first-time investor may believe that managing their own property will save them money. However, it should be remembered that your property management costs are usually tax deductible, and few people have the skills or time to not only find the tenants but choose the right ones. Property managers find your tenants, vet them, collect the rent every month. They deal with tenant requests, organise regular maintenance and pursue action when disputes arise. They'll keep track of rents in your area and make sure your rent keeps pace with the market. In short, a good property manager will help you maximise the return on your investment. Another key consideration is talk to your accountant or a tax professional if you're a first-time investor. For example, did you know you should obtain a depreciation schedule as soon as you purchase the investment property, preferably at settlement? Not a lot of first-time investors do. It's a document that helps your accountant determine how much you can claim back on tax each year. One of the major mistakes people make with investment property is not planning ahead to make the most of their tax deductions. In order to ensure you understand what you can and cannot claim, you need to talk to a tax professional or your accountant. Early on in the process, getting it right will help ensure you come out ahead and enjoy substantial savings and deductions over time. And the last point I want to touch on is getting your finance strategy right. Before you commence your property investment journey, it's wise to make a plan about what you want to achieve. What are your goals and objectives? Sit down with your finance broker who will tailor the right financing to help you achieve these goals. Taking a haphazard approach to financing and your subsequent investments could cost you money, impact cash flow, and limit the amount of investment properties you can actually acquire over time. So formulating a finance plan will consider your goals, your personal circumstances before you even consider making that first property purchase.
Great, Anthony, very informative. Thanks a lot for your time.
No worries. Thanks, Connor. Cheers.